All right, let's talk about funds. You've heard the words, right? Index funds, mutual funds, ETFs. They get thrown around all the time. But what do they actually mean? And more importantly, what do they mean for your money? Well, in this explainer, we're going to break down 4 of the most common ones. We're going to make it simple, make it practical. Let's get into it.
Seriously, it's the question on everyone's mind. The whole world of investing can feel, well, super complex, maybe even a little scary. So our goal today is really simple. We want to cut through the noise and give you that clarity that honestly can take years to figure out so you can actually understand what's going on.
Okay, so before we dive into all the different types of funds, let's start at square one. What even is a fund? Honestly, at its heart, it's just a group of people pulling their money together to buy stuff. That's really it. Instead of you trying to buy a bunch of different stocks all by yourself, a fund does it for the whole group. Simple as that.
And you know, there's a really great way to think about this. It's like throwing a huge birthday party. Instead of one person having to pay for everything, everybody chips in, right? And with that big pot of money, you can get the cake, the music, the decorations, the whole shebang. No one person has to cover it all, but everyone gets to enjoy the awesome party. An investment fund? It works the exact same way.
So if you remember one thing from this whole explainer, make it this. Pretty much every difference between the funds we're about to talk about boils down to one of 2 big ideas. Is the fund passively managed, meaning its whole job is to just copy the market? Or is it actively managed with a real-life team of people trying to beat the market by picking winners? This one idea, passive versus active, is the key to unlocking everything.
So let's start with that passive path, and the one you've definitely heard of, index funds. You hear it all the time, right? Just put your money in a low-cost index fund. But what does that actually mean? Let's take a look.
An index fund is super simple. It just copies a list, which we call an index. Think of an index as just a shopping list for a specific part of the stock market. You've heard of the S&P 500? That's just a list of 500 of the biggest companies in the US. The NASDAQ? That's a list that tracks all the big tech companies like Apple and Amazon. There's no manager guessing or trying to pick stocks. The fund just buys whatever's on the list. That's the whole strategy.
And here's the beautiful part. Because there's no expensive team of managers actively picking stocks, the costs are, well, they're incredibly low. I mean, this is the power of passive investing right here. Some index funds have an expense ratio, that's the fee you pay, as low as 0.02%. You know what that means? For every $1,000 you have invested, you might pay just 20 cents a year. 20 cents! That's it.
Now, here's a little quirk about index funds you got to know. Unlike a regular stock, you can't trade it minute by minute throughout the day. Instead, all the buy and sell orders get bundled together and are processed at one single price after the market closes. For most people who are investing for the long term, this is totally fine, but it's a really key difference to be aware of.
Okay, so if index funds are all about passively copying the market, what's on the other side of the coin? Well, that's where mutual funds come in. These are all about trying to beat the market. When you buy a mutual fund, you're making an active bet that a professional manager knows what they're doing.
Yeah, this quote from our source material really gets to the heart of it. With a mutual fund, you're paying for a professional, sometimes a whole team of them, whose entire job all day long is to research, analyze, and decide which stocks to buy and which ones to sell. And their goal is to get you a better return than the market average.
But of course, all that brainpower comes at a price. The fees for these actively managed funds are way higher. I mean, it makes sense. You're paying the salaries for those managers and their analysts. But here's the catch, and it's a big one. Study after study shows that most active managers, they don't actually beat the market over the long run.
So you might be thinking, okay, what if I want the super low cost of an index fund, but I want the flexibility to trade it whenever I want? Well, that's what brings us to our third category, the ETF, or exchange traded fund. This is really the modern hybrid of the investment world. It's kind of the best of both worlds.
And here is the absolute game changer. While index funds and mutual funds get priced just once a day after the market closes, ETFs trade all day long on the stock exchange, just like a share of Tesla or Microsoft. This gives you total control to buy or sell whenever the market is open. And because most ETFs are also passively managed, their costs stay incredibly low, just like index funds.
Okay, let's shift gears and step into a completely different universe now. Let's talk about hedge funds. These are not for your average, everyday investor. This is an exclusive, very high-stakes club. It's designed for super wealthy individuals who can afford to take on way more risk,
all for the chance at earning much bigger returns.
So how do they chase those huge returns? Well, with really aggressive, sometimes risky strategies, and with incredibly high fees. Hedge funds are famous for their 2 and 20 fee structure. Get this, that's a 2% fee every single year on all the money in the fund. Plus, they take 20% of any profits the fund makes. It's a massive, massive cost that demands incredible performance just to break even.
All right, we have covered a ton of ground. Passive, active, trading once a day, trading all day. Look, the best way to think about these isn't that one is good and one is bad. They're just different tools in an investor's toolkit, and each one is designed for a very specific job.
And this chart just lays it all out perfectly. You've got your index fund, passive, simple, super low cost, great for long-term goals. Then you have mutual funds, active, expensive, for people who really believe a specific manager has the magic touch. Then there's the ETF, also low cost and passive, but with that all-day trading flexibility. And finally, hedge funds, they're in a whole other league. High risk, high fee, and really only for a specific type of wealthy investor.
So, what's the bottom line for you? Well, the main takeaway from all our research is pretty clear. For the vast, vast majority of us who are just looking to invest for big goals down the road like retirement, the simple, diversified, and super low-cost approach of either index funds or ETFs is the most common and widely recommended place to start.
At the end of the day, understanding these 4 funds isn't about finding the one single best one, because there isn't one. It's about knowing what tools are out there and what they're designed to do. So the real question isn't which fund is best. The real question is, now that you know the tools in the toolkit, what are you going to build?